Welcome to Proactive Wisdom TV. If you are new here, be sure to subscribe to the channel so that you are notified every time a future upload happens. Today, we're looking at what happened with Silicon Valley Bank. If you have not yet heard, Silicon Valley Bank, also known as SVB, collapsed on Friday, March 10, 2023. On Wednesday, March 8th, SVB started selling its securities at a loss, and its stock had severely plummeted by Thursday, March 9th. At this point, venture capital firms had advised their companies to withdraw their money from SVB. Due to this bank run, where depositors withdrew more money than the bank had on hand, SVB collapsed in under 48 hours. This is considered the largest collapse of a U.S. bank since the failure of Washington Mutual in 2008. So let's back up a little more to understand what exactly happened. Well, in 2022, the Federal Reserve started aggressively raising interest rates in an attempt to combat inflation. This move by the Federal Reserve simultaneously caused the value of bonds to significantly decrease. For context, bonds are defined as a debt security where the issuer promises to pay the investor back at a specific rate of interest after a certain period or when the bond becomes due. This is an important issue to understand because when businesses deposit money with a bank will keep some of the funds on hand to satisfy their required reserves, and then they will loan out what they consider to be excess reserves in an effort for the bank itself to make a profit. Now, normally this isn't an issue because businesses like the ones affected here, like Roku, Roblox, Etsy, and BlockFi, to name a few, don't often need access to all of their money at one time. Instead, businesses withdraw money in bits and pieces as they need. However, with Silicon Valley Bank, the worst-case scenario happened, as higher interest rates destroyed the value of long-term bonds that SVB had purchased using customers' money, and likewise, as venture capital became scarce to startups, then startups were forced to lean on their own funds held within SVB to keep their business operations going. In essence, this means that substantially more of SVB's clients were withdrawing their money while SVB still had the funds in the bond market, realizing greater and greater losses with each passing moment. By the morning of Friday, March 10th, SVB had all but given up on its efforts to raise capital or find a buyer who could help them get out of this messy situation. This resulted in California regulators shutting the bank down and the Federal Deposit Insurance Corporation, FDIC, taking over. The FDIC moving forward will pay customers of SVB up to $250,000, which is the insured limit. By Monday morning, March 13th, insured depositors will have access to their funds up to the insured amount. For depositors who hold more than the insured amount at SVB, the FDIC will pay an advanced dividend within the next week. Because of this collapse, investors can expect the week of March 13th to be riddled with volatility in the stock market. Use this as a learning moment for us all. Our best laid plans are often our worst made decisions. We'll have to stay tuned to see what else happens. For more interesting videos like this one, be sure to subscribe to the channel and share this video with a friend. Keep your focus on your goals, and until next time, keep striving.